Okay. So again, obviously, just as an introduction, purpose of the webinar today is just to talk a little bit about what social investment is and what blended finance is, and maybe obviously take away some of the kind of the questions and the queries that people have about that. Again, it's going to be myself talking about the social investment and blended finance piece, and then you'll hear from two youth grantees that have then gone on to secure a new social investment really successfully. Cameras and microphones will be off. If you post questions in the chat as we go, and then we can get them at the end of the call. And again, the session is going to be recorded and it'll be shared on our website. So let me introduce myself. My name is Christian. I'm a senior relationship manager at the social investment business. I've been around the social investment business for an awful long time. It's 19 years. So I've been around charities and social enterprises, social investment from the very early days when there wasn't many social investors around. It was something very new to the market. And obviously you've seen lots of changes or kind of over that period. It's developed massively in terms of new social investors into the market, in terms of acceptance. But there's still a lot of misconceptions around what social investment is and how it can be used. And hopefully that's what, again, this webinar will kind of cover. We have two guest speakers today. We have Leila, who's from the Al Ghazali Multicultural Centre in Liverpool, and we have Abu, who's from the Sunderland International Bangladeshi Centre in Sunderland. Both of those organisations received Youth Investment Fund grants, but then both went on to secure social investment from ourselves. So the social investment business, I think most people on the call will be aware of us because you've had a Youth Investment Fund grant from us. But a little bit of background is we don't just provide grants. We are one of the UK's largest social investors. And since we started going in 2002, we've deployed over £800 million in loans and grants. And basically our mission is to finance social change. So what does that mean? We provide repayable finance, so social investment loans. We provide grants, capital grants, revenue grants, investment readiness grants, but we also provide expert support and innovation. And the reason we do that is to back organisations building stronger communities and a fairer society. So we're here to enable the sector to deliver more impact. That's our role, that's what we do. We have three core priorities. First of which is the green transition, which is tackling the challenges of climate change for the social sector and harnessing the opportunities available from green transition across energy and nature. So green, then obviously, energy resilience. Community infrastructure, which is enabling the social economy to maintain and grow sustainable community assets. And that can include housing, it can include community buildings, and include land. And then public services, ensuring the social economy is at the heart of the renewal and restructure of public services, including design and delivery. So again, a little bit of background around who we are, our track record, and our priorities. So again, we're here to talk about social investment, and why are we talking about this? I don't need to, obviously, as organisations delivering frontline delivery, I don't need to tell you some of this. You kind of get it. Demand for services is rising. It's getting harder and harder to secure grant funding. There's more competition, there's more organisations, grant funding pots are getting smaller. And organisations need different forms of capital at different stages. So, as a startup organisation, you might be really grant focused or raising donations, but, as you grow, you might be in a position to take on repayable investment. But the key kind of message from this slide is social investment is only one tool in the funding toolbox. There's other forms of funding and there's other forms of finance that are available and might be a better option depending on where you are in terms of your kind of the growth stage of your organisation. But again, we'll come on to that. So what social investment is not. So it's not a grant or donation. It's not only for large organisations. I think there's still a bit of a misbelief that you have to be a really large organisation to be able to take social investment on, and I can show you why that's not the case. But the key message here is that sometimes it's just not suitable for an organisation. It might not be suitable for an organisation now, and that organisation could continue trading for the next 10 years, and it might not be suitable then. It doesn't work for everybody. and sometimes it might never work for your organisation. But again, we'll cover that in a bit more detail. So just a couple of definitions. So social investment, these are kind of formal definitions taken from our website and the Good Finance website. It's the use of repayable finance to help an organisation achieve a social purpose. So that one's like nice and short and punchy. Or there's another one, which is charities and social enterprises can use repayable finance to help them increase their impact on society by growing their business, providing working capital for contract delivery, or buying assets. In short, it's funding that helps organisations deliver more impact and other good stuff that they deliver. So again, you think of it as a tool that you use to help you deliver more stuff. The key message that really you take away from this one, social investment is repayable. You're going to repay some of this social investment, and it's normally with interest as well. So circumstances when you might need social investment, so purchasing assets, managing cash flow, expanding your team, growing your revenue. These are all just examples. So if you've got a need that isn't kind of captured on that list, you should still be able to get social investment for it. But not all social investors will fund all activities. Yeah. So in terms of purchasing assets, people think, all right, purchasing assets, that's going to be a building, that's going to be a commercial mortgage. It doesn't have to be. It can be equipment. It could be the fit out of a kitchen. It could be a minibus. It could be play equipment. It could be anything that helps you to deliver your mission. In terms of managing cash flow, all that means, it sounds like quite a technical term. It's just around bridging financial gaps, while you're waiting for funds or public sector contracts to arrive. So if you're having to deliver some work and you have a contract that's going to pay quarterly in arrears, you need to employ the staff, you need to deliver the service. So social investment works really, really well for that. Expanding the team, so it can be investment in staff. That could be existing staff. It can be, training existing staff to be able to deliver more, or it can be, employing new staff to deliver more services. It can be employing business development staff to help your organisation grow. And the other main kind of one is grow revenue, which is investment in commercial activities that generate income for the organisation. Again, that could be something like a cafe. It could be an investment in a building, that makes them more attractive to organisations wanting to kind of rent or hire space. So, but again, the key thing to take from this one is this is just all examples. If there's something that you're thinking about or something that would help you that isn't on that list, it's still worth exploring and having a conversation. Just a little bit about the different types of social investment. So the first one is borrowing. So that's obviously something that's called debt. It's a really one to understand because I think we're all aware of like kind of mortgages and personal loans and stuff like that. As an organisation, you take out a loan, it's repaid over a set period of time. It's normally got a fixed rate of interest, and that loan will be secured or unsecured. So you borrow £50,000, you repay it over 3 years. At the end of the 3 years, the loan is repaid. Really, really easy to understand that one. Shares equity. So we don't see a lot of this because of kind of charity and social enterprise structures, but investors can buy shares in an organisation, enabling a portion of the profits. Where we do see it quite a bit is community shares. So if you're a community and benefit society, lots of those organisations or cooperative, lots of those organisations can sell shares, obviously in their organisation to raise finance. Blended finance. So you'll hear that term an awful lot, and I'll explain a little bit more about why we have it. So a blended finance means you've got a loan, but alongside that, you've got a grant. The loan element remains repayable, but the grant isn't typically. And what it does, it reduces the risk of the overall investment and it increases the number of organisations that can take on repayable finance. Quasi-equity, revenue participation. So this is like, it's a hybrid model where repayments are linked to an organisation's performance, financial performance normally. So it'll be, okay, you get £50,000, but you only repay that if your turnover hits a certain amount or you generate a certain amount of surplus or different kind of financial milestones. And the final one is social impact bonds or outcome contracts. So this is where investors will invest obviously into a social impact bond to deliver social services, and then the investor gets repaid by a statutory commissioner normally if the project achieves agreed measurable outcomes. Just one thing to note, different social investors that tend to focus on one or two of these. I can't think of any social investor that offers all. So as an example of that, SIB, our place in the market, what we do, we just offer really simple borrowing/term loans, debt, and blended finance. But then there's other social investors out there who are only working in kind of social impact bonds and outcome contracts. So blended finance, just want to expand on that a little bit more. So we know it's a grant that sits alongside repayable finance. But what the reason we have it makes social investment more accessible and effective. So there's always going to be a grant, there's always going to be a loan. Typically, the loan will still be the majority of the funding package. So as a couple of examples, we have one at the minute where it's 60% loan, 40% grant. We've had ones in the past where it's 80% loan, 20% grant. So I can't think of any social investor where the grant is larger than the loan. But it's a grant that sits alongside the loan. But the key message here is there's still a loan involved, and that loan still needs to be repaid. So why do we offer blended finance? Well, it improves affordability. So it reduces risk because you're borrowing less money. So if you need £50,000 and a social investor can't get comfortable lending you that much, if they can blend it, then they might only be lending you 35,000 and providing a grant of 15. So it reduces the overall risk of obviously non-repayment. It makes an investment more affordable for an organisation because you're only borrowing 35,000, so that's what you have to repay. And what that does, it allows social investors to agree more deals, but we can do more deals at the riskier end of the spectrum, which means we support more organisations to kind of deliver more impact. But yeah, I mean, again, the key takeaway is it's a grant that sits alongside the loan. The loan remains repayable. Just a little bit about what social investors look for. Everybody asks about the legal structure. The legal structure is less important than it used to be, as long as you have a social mission, an asset lock, and a rule on the distribution of profits. Most charities and social enterprise that we talk to already have those. So if you're a company limited by guarantee, if you're a registered charity, if you're a CIC, if you're a CIO, you automatically have that as part of your legal structure. If you're a company limited by shares, we can still invest in you, but you have to change your governing documents to put those three things in. Social impact. We are social investors, and the social impact piece is just as important as the financial case. So what we look at what you're delivering now. What will the social investment allow you to deliver? It doesn't always have to be growth. People sometimes think, well, if I'm taking on social investment, they want me to grow my kind of business or kind of expand into a new area. Sometimes it can be about maintaining services, which can be just as important. So it doesn't always have to be growth, but social investors are incredibly interested in the social impact piece. In terms of the track record, that's obviously for both the organisation and the people involved. Social investment, quite often what we're doing, we're investing in people. So we're always going to be really interested to know about the governance team and the leadership team and what their track record is. In terms of the organisation, if it's a service that you're looking to expand, well, how well have you delivered that service previously? If it's a new service, do you have the skills and expertise to be able to deliver that new service? Is there a market for that new service? I don't know if you want to introduce like a daycare nursery into somewhere where there's already five existing successful daycare nurseries. Is that really the best idea? So the track record, and in terms of obviously what you want to deliver. In terms of the financial, well, actually, I'll talk a little bit about governance. So in terms of governance, how strong are the governance arrangements? This is relative. So, a national charity that's turning over, £80 million a year is going to have more robust governance procedures than, maybe it's like a CIC that's turning over £100,000 a year. It's just the nature of it. Social investors understand that and factor into their decision making. So when you come to a social investor, if you do, Just be honest about the governance arrangements. So if you don't have a finance subcommittee, if you're a £20 million turnover organisation, I'm already expect you have one. If you're turning over £400,000, I really don't. But just be really honest about the people involved and the governance arrangements. Financial, look, financial track record is important, but it doesn't have to be perfect. Social investors, we can live with deficits. We can live with kind of weak balance sheets. We can live with, a lack of cash. Quite often, that's what people are looking for social investment for. But we want to understand the reasons why. So in terms of what's happened over the last few years, and then obviously, and what the future looks like. The reason we're so keen to know what the future looks like is, and again, I'll tie it back. It's a loan, it's repayable. At some point, you're going to have to kind of make repayments on this. So the repayment part, the social impact piece is really important. The repayment part is also really important because, what is going to be the source of income that's going to enable that repayment. And, we look at things like how secure it is. Some examples, if you are purely an organisation that gets grants, well, you can't use those grants to repay the social investment. And that goes back to what I was saying about social investment sometimes isn't going to ever be right for an organisation. But if you're generating income, and that could be things like income from the sale of goods, products, could be from, the income delivery of service that a commissioner pays for. It could be, obviously individuals paying for things. So I don't know if you're doing something where people are using their personal budgets, or like I say, it's a daycare nursery or anything like that. If there's some form of income generation that can be used to repay the loan, then that's what the social investor is looking for. Application process. Do your research. Different social investors have different funds that fund different things, and have different eligibility criteria. So don't waste your time like talking to and approaching ones that won't be able to help. And the way I always, I'm going to point you to some resources that can help in terms of research. But most social investors will be perfectly happy if you pick up the phone before you apply. So do your research first. Good finance website. So that's a really good source of information for social investment in general. And it's got an investor directory there. So you can search using different criteria, like where you're based, how much you want to borrow, what type of investment you're looking for. So that's a really, really good one. 2 seconds, sorry. Ask. Be really clear on how much you want and what you want it for, and what difference it's going to make to you and how you're going to repay it. Financial info. So not all social investors are going to ask for the same things, but typically they want to see the last 3 years of annual accounts. They want to see your latest management accounts, and they want to see a cash flow forecast that hopefully demonstrates obviously your ability to repay the loan. So in terms of the application process, most social investors have a similar application process. You fill out an online form with details of who you are, what you do, where you do it, what you want. Ours takes about 30 minutes. You fill out that online form, you send in your financial data, and then the way we describe it is that's the start of the conversation. So it's not like you don't put a 20-page application together and then it's a yes or no. You send some information through, and that's the start of the conversation. Timescales, people always want to know that one. It can just differ. It depends on how risky something is. It depends how detailed something is. But best practice would be to plan for at least 2 or 3 months, because it can take that long. Decision making. So most social investors have an investment committee. So somebody like me will go away. We'll kind of work with you. We'll get the information we need. We'll write up a credit paper, and then we'll present it to an investment committee. And it's the investment committee who makes the final decision on whether or not the investment is approved. I just wanted to very quickly touch on our Reach Fund. So the Reach Fund is a grant that helps organisations secure social investment. The key point with this one is you can't just apply for the grant. You have to have approached a social investor, and they have to be interested in providing social investment. And it's often described as like the final piece of the jigsaw. So what I mean by that, you need to have a really good idea of what you want. You have a really good idea of what you want it for and how you will repay it before a social investor would recommend you for the Reach Fund. So you need to talk to the social investor first, and if the social investor feels like they need further work done to enable them to make a decision, that's where the reach fund comes in. Again, I just very quickly wanted to touch on a couple of our funds, and the reason I'm doing this, it's just as examples of the type of funds available. And again, the message is, there's lots of other social investors offering lots of different funds. So these are the ones that we have at the moment. So the Energy Resilience Fund, this is a blended product. So again, it's a loan and grant. So for this one, it's 60% loan and 40% grant. And it'll fund work that improves energy resilience. So it can be for asset purchase. So it could be for vehicles. It could be for equipment. It can be investment in assets. So it could be investment in buildings. It's a minimum investment of £25,000, but 40% of that £25,000 will be a grant. So that means a repayable loan of about 18,500, and it's a minimum turnover of £100,000. So again, the reason I'm kind of mentioning that one, it's a really good example of why social investment isn't just for really large organisations. The entry criteria for that are quite small. The Community Builders Fund, so I've included this one because this one isn't blended funding. This is purely loan, but this one can be used for pretty much any activity. So that's, tying that back to like if you need cash flow, if you need investment in assets, if you need development capital, so investment in people, again, that one can fund pretty much anything. So that one's a little bit larger. That one's a minimum investment of 100,000 and a minimum turnover of 400,000. So again, it's getting a bit more sizable organisations now, but there'll still be lots of organisations that are already meeting that criteria. And Thrive Together, this was a previous fund investment that we did. This one, again, I've included as an example of blended finance. It's 80% loan and 20% grant, but that could be used for pretty much any activity, and the minimum investment was 100,000. So again, it's just another example of social investment not just being for large organisations. I'm nearly done. Couple of key takeaways, and again, referencing to obviously through the talk. The way to think about it, social investment is just one tool in the funding toolbox. You've still got grants, you've still got donations. It's just one tool, and it's not going to be right for everybody. Some element of social investment is always repayable. There's normally interest charged. You can use it for lots of different things. And again, if you ever think, well, could I use it for, I don't know, like a particular project or a particular thing you want to do, it's always worthwhile having a conversation. It's not just for large organisations, but it is right for everybody. And kind of the main one is do your homework. And on do your homework, just a couple of links for you. I've put my email details there. I'm always happy to talk to people about any proposals that they have. There's a link there, obviously, to with details of the Reach Fund. There's a general link there, obviously, for ourselves. And the website that I mentioned before, which is called Good Finance, that's a really, really good resource of helping you better understand social investment and work out whether it's right for you. So that's enough of me. I'm going to shut up now, and I'm going to stop sharing. And I'm going to mute myself, and I am going to pass over to Layla.
Hi everyone, thanks Christian. My name is Layla Mashjari, and I'm from an organisation, a community centre in Liverpool, the Al Ghazali Centre. Just to give you like a brief intro into our work. And so our work began in 1992, so we've been delivering community work for over 30 years now. At the beginning of our time, we were like all over the place. So we were renting out places and buildings, and our work really focused on recreational support and young people. In 2000, we were lucky enough to buy the building that we're in now, and that was through a loan and a lot of community donations. Then having our own building, obviously, that we just went up at another level. We became like a registered charity and company limited, and that meant we could apply for grants, and that got us to organise our project. So We deliver, I think, a bit for something for everyone, to be honest. But our main focus is children and young people. And we deliver quite a number of projects for them through our youth clubs, after school clubs, school holiday activity sessions. We have a very successful karate club. We have an Arabic supplementary school on the weekend with over 200 children on register. And we are the largest supplementary school in Liverpool at the moment. We also have a lot of adult education programs. So we deliver in partnerships with major providers in the city, like the WEA, the City College, the Adult Learning Service. We also have an open door policy, really, to supporting people in any way we can, whether that's welfare, school admissions, applications. We provide a lot of advice and support. We're also part of the Good Things Foundation data bank and device bank very recently. So that keeps us busy and keeps us supporting people in many different ways. When we first moved into our building, we thought, wow, it's a church, it's an old church, the former United Reformed Church. And when we applied to buy it, out of over 30 organisations who actually applied, we were chosen by the charity because they felt that the community work of the church would continue in its building, which was really great for us, obviously. And as time progressed and our projects increased and grew, the building then became sort of too small for us. And for the past, like I think 10 or 15 years, we've been looking at ways we can bring in capital funding. And we did a little bit of this just before COVID. So our building comprises of a basement floor, ground floor, and first floor. This was originally. So it was getting too small for us. So we wanted to look at investments. And then, quite recently in 2023, the Youth Investment Grant became available. And we thought, wow, this is great. This is what we need. So we did the application for that. And, after a lot of hard work and waiting, we were successful. And then our building work began. And, as you can imagine, with having a church, there was things that were hidden we hadn't seen. And even because the issue with the youth investment grants was, and I think this was the general issue across the country, that we applied and we put costs in, but by the time they'd accepted the projects, it was like 9 months later. So even, costs of steel and everything had increased. So when the tenders came in, most of the tenders were well above the amount of money that we had requested through the IF grant. But we managed to negotiate with one particular contractor who was very supportive. And obviously we had to phase out some of the work as well. So we had to phase out the work in our basement area and focus on the ground floor and the first floor. And through the youth investments, we also developed a new floor, our second floor, which was a new mezzanine floor. So that gave us extra space to use in the building, which was great. And as the work began, there were things that we didn't anticipate. Costs were then, rising. We were already low on budget and things were just increasing, with the old church. So say, for example, in our hall, we had this large stage in place from when we bought the building, and we thought it would be easy. We'll just remove it and everything could be all right underneath. But the beams underneath were not straight. So they were sort of like, well, they weren't straight, they were slanted. So we had to spend, I think, nearly over £20,000 just to get them removed and then replaced. We've also got like a rose window, and realised that rose window wasn't very safe, and it was actually too expensive to replace it completely. So we had to bring in a specialist engineer, and then it had to be made safe, but that cost nearly over £15,000. So there was just things that were increasing as the building work was progressing. And it was becoming quite scary, for us as management and for the trustees. The bank was like just ticking away, ticking away. And then, so for us, the social investments of the trustees did do fundraising during the building work, and we were quite good at that, but it still wasn't enough. So we did manage to raise like over £150,000, fundraising, but we needed more to cover these arrears. The cost of the building work were just increasing. So the blended finance, and social investments was just a no-brainer for us. It was like, a godsend. So when, going forward with that, it was a bit scary at the beginning because for us as an organisation, there were two things we had to look at. How risky would this be? First of all, would we be able to repay the money? And also, but the amazing thing about it was that it was blended finance. So even though we were getting a loan and we were taking on that responsibility, we were also going to receive a grant, which was the situation we were in. That was like, amazing. So the process, I think, for the application, this is what, like Christian was saying, go for it, ask the questions you need to ask, and you'll hope that the support that you need and the clarity will be there with the team. And I want to thank Christian in particular, because he went through the whole process, and I think his support and hand holding us through the whole process was amazing. And I don't think our application would have been accepted if it wasn't with your support, Christian. And the amount of phone calls, video calls, it was quite a robust and process to go through. It wasn't an easy process, and you have to have everything in place. So all your evidence, your paperwork, making sure that you could produce all your finances, your records, your everything to do with your accounts and the organization's financial stability at the moment and going forward as well. And obviously we were in the middle of a building program. And what I really thought was really good with this as well, with the blended finance, was the 12 months. You get like a respite period where you're only paying the interest back in the first 12 months. And that was really helpful to us because it gave us that time to move back into our building, get our feet back on the ground. And I think our first payment of the loan has started this month in July. So that was, very, very, helpful and supportive to us. I would advise you to make sure that if there's something you're interested in, then make sure that you're ready internally. You have all your process in place. You can produce your financial records, your accounts, your projections, and make sure that you're able to, don't get excited about having the loan or the grant and stuff, and then when it comes to paying it back, it might be difficult. So that's what I would advise, to make sure that you, as an organisation, you're able to do that, and you can. I think that's probably just about it from me.
Brilliant. Thank you, Leila.
Okay.
Thank you for the very kind words. It's very much
No, thanks,
appreciated.
Christine. Yeah.
Thank you, Leila. And now obviously we'll pass over to Abu. I'll let Abu introduce himself again.
Yeah, great. Thank you, Christian. Thanks, Leila, for sharing that. It's a similar story. Yeah, so my name's Abu Sharma. I'm acting CEO for a organization called Sunderland Bangladesh International Centre. We've been going for over about 25 years, opened in 2000, very much led by a community from the BM Black minoritized ethnic community. First purpose-built building in the Northeast back in 2000, and the community actually generated that money through fundraising and European money, and back then lottery as well. So again, similar story. I think we've been going for 25 years, and as Christian mentioned in his presentation, we all know the funding situation out there, grant funding. You can't be over reliant on that. And you've got to just think of something else to generate your own income to sustain it. So we're a community anchor organization with 25 years experience serving Black, Asian and minority communities in Sunderland. We deliver community-led programs that tackle inequalities, from improving access to opportunities and services, empower communities through culturally appropriate and faith-informed approaches, addressing health inequalities, employment issues, and education attainment. So we do that through 4 core areas of work, which is, one area is health and well-being. Within these communities, we know there's a lot of disparities and inequalities around health. We try and tackle that through working with partners, education and training, employment and enterprise, and general cohesion work around community development with diverse communities. So I think, like many VCS organizations, I mean, one of the things that's ongoing at the moment is about challenges linked to grant dependency and finding funding uncertainty. As a result, we've always thought, I've been here for about 20 years since beginning. I started as a trainee, worked up, and over the last, I think, 5-10 years, just try to look at my own self and also try and steer the board of trustees, looking at other avenues of revenue streams in terms of how do we do that, how do we become much more sustainable, we can actually generate income. So we were already generating income through, because it's a community center, we get a lot of community usage, hire of the facilities, hire of the halls. We were generating roughly about 25-30K a year through lettings and hires. But the ambition was to hit a 100K figure. And I think through a mixture of investment and through, earlier days, we were talking about expansion of the building, because over 20 years, the community's grown. I think diversity of Sunderland's grown and needs have grown as well. So the building is not fit for purpose. So one of the things was we didn't really look at young people development. And this is one thing that over the last 5 years, we try to branch into, look at young people's development, young people activities. So I think when we looked at the whole idea of expanding the building, I did reach out to Christian in terms of saying like that we had a model of, can we raise, 100K from the community, 200K from grants, another 200K for social investment. I think there was always that thinking of how do we look at the expansion. And as Leila mentioned, pre-COVID, and I think you get a costings, and an original costing for a building expansion was 800 to 900K. After COVID, that went up to 2 million as well. So some of the costs were just ridiculous. And at a fortunate time, Christian actually pointed out to me as there was this opportunity for the Youth Investment Fund coming across, and we should actually look at that in terms of it fits in with the ideas we're doing. And we were fortunate enough to secure a large chunk of the funding for the need, but it's still not enough to actually look at all of the costs in terms of what we really wanted to do. So as Leila mentioned again, we had to curtail some of the ideas. And one of the curtailing of the ideas was we really had the ambition of commercializing our kitchen and refitting that as a commercial purpose, so we can actually do large function and large catering, which we thought, well, we do think, and we unfortunate enough now, well, I'll talk about it, like bringing large revenues for us. So I think the whole thinking of taking on the social investment was about revenue increasing, diversifying revenue streams, and actually modernizing the kitchen, which unfortunately the Youth Investment Fund could not cover because of other pressing needs in terms of modernizing the building for young people's usage. So we did that. So what did we use the investment for? Basically, we had a large kitchen anyway. We upgraded the equipment so it was more commercialized, and we fitted the kitchen out and bought in equipment that actually cater for 1,000 people or 1,000 people event or 500 people event as well on that. So large scale catering events, increasing both usage of the facility and income generation. So we thought if we could deliver that, we had a venue previously at 200 people. Now with the expansion, we get about 350 capacity. So we can go large community events. And when we have large community events, they look for, traditional Asian weddings as well, and community weddings. And we could actually do the hall hire plus catering in-house, that would be generating a lot of income for us. I'll give you an example. Like previously, we were generating 25, 30K. I think just by the first, it took us about 2 years to complete our work. So we moved in June, but we didn't get operational until about August. So I'd estimate, I'm just looking at the accounts, we're doing about 60K of income. So we're on the track to hit that 80, 90K, 100K in the next 3 years, which I'm hoping we will. And what that does is that makes a core building as a community anchor sustainable. Forget the project works, like inequality work and all that. We can actually tender for these and get grants to do that. But actually making the community facility sustainable, the whole ambition of the Board of Trustees and my ambition was to make, how do we generate 100K so we make the organization sustainable as a community use facility? And I think we're hitting that target, and the investment allowed us to do that. I think why finance at all? And I think I looked at that, and I touched on, we already looked at the youth investment fund coming on board. We already discussed how could we actually approach a model where we can actually do our ambitions of expanding the facilities, modernizing it through mixture of donation, community donation, grant, and social finance. So the social finance is already in the conversation. But I think one of the hardest part was that we're not a big turnover organization, maybe maximum 300-400K as the things is. So I wouldn't say we have a robust finance model in place for a charity organization, small charity organization. But whether the Board of Trustees were equipped to take on, that's another thing, I'd say. But the reality, obviously, if I'm being honest here and say reality, there was a lot of dialogue and conversation needed with the Board of Trustees to convince them about that approach. And there is still ongoing conversation because the managing Board of Trustees are answerable to their users, and they still the questions are, why do you take the finance on as well, still now. But the whole element was they took that risk, and I think it's paid off. And I think what my question is that we see the benefits now, it's paying off on that. So taken on, and I think some of the smaller charities and social enterprises is that at times, as there are products out there, and one of the best products was that this is a blended approach. So I think we could actually convince them, look, there's a 60-40 approach here. You get a 40K grant here to actually manage this piece of work, and a 60K, so the risk was limited in terms of that. On that, so I think for me was, yes, definitely, did income come into it? And yeah, the whole thinking was this investment would actually allow us to generate more income, and it is doing that. And as I've said, in the 9 months, we're hitting doubling our previous income, and that shows it's actually paid off. And hopefully at the next AGM, we can actually point that out to the user and say, look, this is why the investment was needed as well. So what we're doing is that we're on track to actually, for the next, by 5-year timeline, we want to say like we've got continuous 100K of income coming in through sales and lettings and income generation, not grant dependency. So if ever there isn't any grants out there, you could actually sustain your building through having a building manager and an admin worker just to run the building itself as a community use, no matter what on that. So as I said, what did it involve taking in? And I think there was a lot of persuasion needed from my part and sort of like-minded other. So what I remember is sitting down with the Board of Trustees and actually getting other people in who'd actually taken on investment before, just to share their stories. So actually showing that what was possible and why they used it. So again, I did user reach as well. I used the reached approach to actually bring in an expert to work with to develop a business plan and costings financial model as well. So that could be actually put on the table for Board of Trustees to make that decision. So I think the reach element was a good element. So I think I got 15K paid external support to come in with expertise to work with us on the Board of Trustees to actually, alleviate some of the worries towards risk. So I think this is in essence essential in doing that. So if you can bring like-minded models locally that have done this, it's good to show that. So eventually we did accept it, and the board of trustees went on, and I think it's 2023 again. The first year was repay interest only, allowed us, and I think it was only last year we started paying interest. And another thing is that you do have a relationship manager that actually checks in with you, and I think this is one of the best things. What we found with SIB was you had a relationship manager to work through things. And I think that ongoing support, and also the relationship manager does actually point you into the capacity building support for individually, for myself as well, and the board of trustees, what we need. So using that external support was crucial. It's not just about the money they provide, which is beneficial, but the added on support that's beneficial. So I think, yeah, sometimes you feel like, oh, well, we've got the loan, but why do I have to do this, give the management accounts and all that? But I honestly think it keeps you on your toes, as an organization. Are you on track to use your management account, saying what it is saying? Are you on track to actually get to your goal in terms of at the end of this period of borrowing, I would say? So I think that is helpful as well. And sometimes I can say oh, well, it's too many meetings. I would have produced too many management accounts as well. But again, if you look at it the other way, it's a positive thing. It's keeping you on your toes to be and also targeted towards your goal on that. So how was it actually like for me? For me personally, I like the challenge of trying to do that on a personal level, but I don't think some of the board of trustees like that in terms of that. I think they still question that. Some of people like, why did we take that risk on? But I think some of the myself, I can justify it by saying by what we've achieved over the last 2 years with the huge youth investment fund investment and also with the social investment blended finance. What it's doing is that it set us up for the next 20 years in terms of how we as a community anchor organization continue to support our communities as well. So what we're seeing is that through the youth investment fund, where for the last 3 years we've got young people, or 4 years, we actually every week we're working with about 300 young people from the ages of 7 to 18. So that's a real investment through youth investment, but that's one new area of work we've done, because young people are as a succession planning for the community in terms of it's their community facility. They need to be involved in it to take things forward. So we see that very much. So what would I say? What we've learned is that there is something for everyone. Yeah, the whole element was because we took the plunge because the element was blended. If I'm being honest, is there's not many traditional loans out there will say, look, you've got here's a grant and he's a loan as well. So the opportunity to actually fulfill our aim of 100K, to actually really have a meaningful impact in what we wanted to do, so it made it much more easier. So you're actually only paying for 60K for 100K's work. So it was a no-brainer for myself and some of the board of trustees, senior board of trustee members on that. So we do that. So again, it depends on the individual and the organization, just weighing up. And I'll just echo what Leila says, trying to do a bit of research. And as Christian says, what's out there, there are other products out there. We know that, SIB, what they offer, they might be not suitable, but there are other social finances out there. And within in my area, the Northeast, I know the mayoral offices started doing that, and a lot of the funders are doing that as well. It's not just a new thing, and I think a lot of the big funders, I know for a fact the lottery are looking at to do it. The Ram Foundation are going to be doing that. So a lot of the funding, big funders are going into that blended grant social investment. So I think as a charitable organization or a KIC, we just need to be aware of that, and we need to be able to accept that. I'm not fit for people, but if you really want to have a greater impact, and this is what we're doing, we're having a greater impact because of this investment. So what I can say is I've been fortunate enough to get support from Julie and Christian, the ongoing support for what we've achieved, and youth investment and the social investment recovery loan has been a big bonus for us in terms of what our ambitions as an organisation to grow and generate more income.
Brilliant. Abu, thank you so much for that. that's like really good to hear. And again, thanks for the positive feedback for like myself, Julie, and SIB. We do have some questions. So obviously I've answered one of them, obviously, as we've been going through. So Anthony, if it's okay with you, I'll read your question out, and obviously it's for Leila and Abu, and I can talk a little bit about this as well, if that's helpful. But obviously the question is for you guys. Were there any concerns around Sharia compliance from your boards or community? It's something we're seeing a lot more of. You guys talk about it rather than obviously me talk about it.
Well, I think that is a question that comes up.
Yeah.
You know, I think I'm not saying that it didn't come up. It did come up. So some people, individuals are very, very strict to that. They have questioned that, and it is not denying that. But if we're going to be really, my question is that if it's really questioned that, then we shouldn't be accessing any kind of grant funding, you know, to achieve some of the objectives. If I'm on a personal level, that's my personal opinion. If you're going to be really compliant on Sharia law and all that, then as an organization, we shouldn't be accessing any kind of grant funding, especially not the national lottery, you know, because it's seen as, you know, playing lottery as well. So that was mine, but not saying that it doesn't. But I think there are some social finances where I've recently worked with a mosque that is looking at expansion work, and they actually raised that they weren't going to be taking it on. But we did actually have a chat with one of the social investors about how do we actually come across that in terms of not interest or Sharia, and they're actually looking at that.
And what about you, Leila? Was that a discussion you had to have with your board?
Yeah, to be honest with you, it was, and it was something that, as a board of trustees, I think they you know, they prefer not to do things like that. But obviously, we had to look at our circumstances.
Yeah.
And you know, having the support of the loan as well as the grant.
The grant is
was very supportive, and I think the situation we were in, you know, didn't leave any room for us not to accept, to be honest.
Can I just make a comment as well? Again, it goes back to what I said about, you know, social investors providing different forms of finance. There is now a social investor that provides a Sharia compliant investment package. It's not us. It's a social investor called the Key Fund, which invests primarily in the North, in the Midlands, and they work obviously with a group in Bradford, can't remember their name, to develop a Sharia compliant product for them. But they have made that Sharia compliant product available to all any organisation, as long as it kind of fits their criteria, and it's based in the North and the Midlands. So yeah, obviously the Sharia compliance thing, yeah, a really important part of the discussion. And again, I think it's around, you know, it's evidence that social investors will deliver and develop kind of products and services that kind of work for people. So thanks for that. That's it in terms of time. I mean, if there's any more questions, then again, as I explained in the meeting, I've put my email kind of address there. If you didn't take a note of it, just look at Social Investment Business. Look at, obviously, like you say, the contact details, or look at staff and I'm on there. And again, you know, just thanks to everybody, obviously, for attending. Particular thanks to kind of Leila and Abu, and obviously come along and tell the stories of Sunderland International Bangladeshi Centre and Al Ghazali Multicultural Centre. And thanks. I hope it was useful. Thanks, everybody.